Hello, everybody, and welcome to ETF Build's webinar on ETF Capital Markets Outlook, Capacity, Liquidity, Multi-Share Class Dynamics. We have a fantastic panel for you today. And before we get into the discussion, I just quickly want to introduce ETF Build. The ETF Build project was started a number of years ago by four industry professionals. John Jacobs, the former executive at NASDAQ and instructor at Georgetown University. Bibb Strench, a partner at Thompson Hine, and Justin Mice, president and founder of Buttonwood Communications, and myself, Richard Keary of Global ETF Advisors. ETF Build was built to create industry discussions for industry professionals about what's happening in our industry and in the ecosystem, and to highlight various issues and concerns, which we'll be talking about today. And ETF Build is an acronym for Business Insights and Leadership Discussion. So our discussion today is with three professionals from the capital markets space. Chris Hempstead from Array, who's representing sort of the AP community, approved participants. We got David Pinella from GTS, looking at the world from a lead market maker perspective. And Nick Phillips, a longtime industry professional who sits at the issuer desk as a capital markets professional, coordinating with the APs and the lead market makers to make sure that function operates. From my perspective, the capital markets function is absolutely the most important part of the ETF ecosystem. You can build the best product in the world, you can have the best sales team, you can have the best operational partners. But if you can't drive liquidity into your product, and there isn't people out there risking capital to support your product, you're not going to have a product on the marketplace. So this is absolutely the key to the industry. And we want to take a look. The industry's cranking. We have record number of issuances. We have record numbers of AUM. You know, it feels really good, but there's some cracks are starting to show up. And we want to kind of explore that and see if there's some real concern and things that we should be thinking about for the future. So with that, let me start off with introductions. And Chris, why don't you start a little bit about yourself and your firm and your role?
I've known you and the fellow panelists for most of our careers. And so, you know, I'm honored to be part of this. At Murray Asset Securities, what we built out was, as a self-clearing entity, we established ourselves as an authorized participant in as many ETF trusts as we can possibly get signed up. I think we cover most ETFs. There's probably a small handful that are still coming out that need to be executed, but we act in that capacity. We can, you know, that allows us to seed ETFs. It allows us to create and redeem inventory for our own needs. And it allows us to work closely with the asset managers and sub-advisors to help them efficiently rebalance ETFs. I think we'll probably touch deeper on that as some of the pain points discussion, but, you know, we're a full service broker dealer and we're global. And it's been a lot of fun. I've been there 4 years and building it out, and it's, I don't know, every day is new. Never stops.
That's the great thing about the industry. Every day is a new day.
Yep.
Always something going on. David, how about yourself?
Dave Pinella, I'm over at GTS. I run the institutional desk over here. GTS has a large focus on lead market making in addition to servicing the entire asset community, both the facilitation of ETFs and other asset classes. We have over 400 ETFs and are also a market maker on many of the other names that you might find across the board through our wholesale market making team. Very much focused on servicing the industry and making sure that we can provide liquidity at all levels. And I have to echo Hemp before, known you gentlemen for quite a period of time, and very honored to be here with you all.
Yeah, I appreciate that. Thank you. And Nick, what about yourself?
Hello, everyone. Thanks for having me, Richard. Yeah, so my name is Nick Phillips. I work right now for my own firm, consulting firm, ETF Capital Markets Advisors. But I've spent the last 26 years or so in the ETF industry. Started off as a market maker, lead market maker, even worked at the same firm as Chris Hempstead for, I think, many years, seven or eight or so. And then after about 17, 18 years in the LMM business, I went over to the issuer side where I worked at VanEck, GQG, and a few other firms, and the role of capital markets, ETF capital markets. And so I've been on that side of the business ever since. And to me, it's a very important role. Basically, you're kind of like the subject matter expert in the firm, along with being the conduit or go-between between Chris and David's firms. So basically, you're kind of part of you're an integral part in the ETF ecosystem.
Great. Well, thanks, guys, and welcome, and thank you for participating in the webinar tonight. And I think your insights are going to be incredibly valuable. Nick, let me start with you. Can you give us sort of an overview of sort of the role of APs, lead market makers, how you fit in the middle, how you work within an issuer to coordinate all these activities and information?
Right. So as an ETF capital markets person, you're kind of that person that deals with everything outside of the firm. So you're dealing with the exchanges, all the APs, all the market makers, and you're kind of there to be the go-between between the portfolio managers and the ETF issuers themselves and the outside world. So you create these relationships and you build these relationships with lead market making firms and AP firms. And the more of those relationships you have, the more people that are involved in your product, usually the better run the product is. So, if you have more market makers in your product, the tighter the markets are, the tighter the spreads are, the better liquidity is. The more APs that are involved with your ETF issuer, the more market makers that could be involved. So really, it's about building relationships and then also understanding the product itself. You need to be that expert so that an AP or market maker has a question about your product, you can answer that. And if not, you get the answer right away, because any doubt in the ecosystem causes less liquidity and assurances for those that are investing in your product. So an ETF capital markets person, you're dealing with every function in the ecosystem. You're dealing with the all the players outside, but you're also there for the sales team. The sales has a question, and their investors want to know how the liquidity is of the product, how do they execute the product. You're basically there to answer all those questions and put the rest any doubt that those investors may have. You're also there for the marketing team and portfolio managers, product developers. So you're basically a Swiss Army knife in the ecosystem.
I've always viewed you as that, so that's good.
Thanks.
Chris, let me switch over to you now on the AP side. It was interesting in your introduction how you talked about the number of ETFs that you are supporting as a firm. You talk a little bit about, why, right? What are the incentives and economics for Murray or any AP firm to get into that space? Because, right, if we're talking about capacity issues, one solution is, get more players. Do we get more players into this space? Do they come into the AP world? Do they need to come into the AP world? Just your views on that capacity issue as a whole.
Sure. I mean, it's interesting. It's sort of one of those things like when you execute the agreement, it's a legal agreement. Basically, the legal agreement, the authorized participation agreement, is a legal document that permits the clearing member firm to submit for create and redeem orders directly with the trust, with the agent bank. It's sort of it's like a driver's license, for the fund. And once it's executed, it's kind of, you have it forever. It's free to have. It doesn't cost any money to have the AP agreement. But why is it important? That's really the better question. So Nick alluded to the fact that the more APs you have, it gives access to more market participants to access that service, if you will. So we are also a clearing firm and a prime brokerage firm. So, for example, if a market making firm was clearing and priming business with Murray, and they wanted to trade an ETF, they would ask us, "Are you an AP in that ETF?" Because they really would have a harder time trading that ETF if we weren't. In order to trade in the secondary market in ETFs, you need to know how to price the ETF. That's what market makers do. But you have requirements to make settlement. And so if you're selling an ETF short to the market, you need to make delivery on that, or you'll get, or there's something called reg show. And in equity markets and in ETF markets, the easiest first place to go to make delivery for a security that you're short is the stock loan facilities. But ETFs, by and large, are easy to borrow, but most of the roughly 5,000 ETFs in the U.S. market don't trade a whole lot. So the stock loan facilities don't really have deep availability in the majority of ETFs. The top 1,000, sure, they're readily available, but thinly held and newer ETFs, which is the majority of them, if a market maker is short, most likely they're going to need to create. Now, there's a couple of big banks that clear business for a lot of the major market makers, and their APs and everything. And so they have a process where they're continually making markets and ETFs, and they're constantly creating and redeeming, trying to keep their exposure at an optimal level. And all of that is done to make settlement to end users, buyers, retail, institutional, people who are shopping for these products on the exchange. They want their trades to settle. And the way that ETF trades settle, by and large, is in the absence of natural inventory in the market, it's through creation redemption facility, or the services of an authorized participant. And we're not a bulge bracket bank, but we do have a fairly healthy amount of create redeem activity every day from market participants who need support in that capacity. Maybe they don't do business with a big bank, but they do business with us. So, the busier they get, the more create redeems we're getting. And we don't even have to be trading these names. We're just literally using the agreement, processing the creation or redemption order, and transferring all of that back. The other reason it's important for us to have it is we do run a global portfolio trading desk. That's a revenue generating business. And, I mentioned it earlier, but there's the tax efficiency of the 40 Act structure, and creation and redemption plays a large part in that, but it requires balance sheet of the participants. So if I'm going to create, $50 million of an ETF in anticipation that I might be redeeming it at some point down the road for a custom basket, I have to pay for that balance sheet usage. And, interest rates are moving around, and I think they're coming back in the direction we want to see them come, but capital's not free and capital's not unlimited. And so that's why it's more important now than ever before that more participants can act in this capacity to be a part of this ecosystem, because as the market continues to go higher and the assets continue to grow and more funds come to market, unfortunately, the number of market makers and AP facilities isn't increasing at the same pace. And so as the total size of the market continues to grow, the capacity at each of the participants that are doing it starts to shrink a little bit, right? Relative to the size of the market. So, we felt it was important to get in, even as a smaller player. It was very important to get in and provide those services. And we were right. I mean, there's plenty of demand.
Great. Just before I follow up on that, let me run over to Dave. As a lead market maker, and as you mentioned, you're covering about 400 ETFs, right? You're really at the forefront of that balance sheet issue about committing capital into the marketplace for these ETFs. Can you talk a little bit about that from a lead market maker perspective? How much pressure is on you to commit that capital, especially now where you're seeing more and more new issuances? Where are you feeling your pressure points?
Absolutely. And this is really all about partnerships within the industry, partnerships with your issuers, partnerships with, if they're using one of the white label services, or partnerships with your APs that you're using. And you want to make sure that your offering is holistic and that you're providing and meeting expectations as you become a lead market maker or just a regular participant within this ecosystem. In terms of capital constraints and liquidity issues, I mean, every lead market maker, as they come in, they are committed to provide liquidity on the bid and ask. And if you think about that, and you're offering $5-10 million up and down on the books, and then you do that multiplied by 4 400 names, 500 names, 600 names, you end up with quite a significant amount of open orders that are out there. And I mean, listen, this is the job of the LMM. This is what you're supposed to be doing, is you're supposed to be offering liquidity out there. But as that scales, if you think about how many new launches have come to the market, there is eventually a capacity issue to how much capacity you can have and how much overall capital could be out there. So it's important to understand in your relationship, in your partnership with the issuers that you're going to be LMM for, what is the expectation level? What are they doing to support this ecosystem and supporting you as an LMM, in addition to where are you able to provide liquidity? Where are you able to provide the spreads?
Okay, thank you. So Nick, you're sitting on your desk in between the APs and lead market makers and your issuer. As an issuer, where are you feeling the capacity issue? Right. So if you're launching new ETFs, seed capital is an issue. Getting a fair market in there is something you're looking at as you're choosing your lead market maker. You're signing up APs. So where are you feeling from that role a pain point?
Well, I think there's a couple different areas to look at. First of all, like I know at a couple locations that I've been at, a lot of them were doing a lot of self-seeding, so that because they just it wasn't as easy to come along. A lot of market makers don't want to seed all that often anymore because you need to have the right partner. Is if it's an ETF that issuer that's going to really market the product and they have a sales team, well, maybe that seed capital doesn't sit on the books all the time. But then there are other issuers that think they just create an ETF and then all of a sudden miraculously they have assets under management. So what you need to do is describe like the effort that you're going to put in to trade your product, sell your product to whoever your partners are going to be, the LMM. So you can either self-seed or you can look for a partner that will seed your product. But I'm thinking, the more I've seen the last couple of years, there are fewer and fewer people that really want to put up that much capital unless they're willing to, or at least they have faith that you're going to be a good partner and try to at least do your part in selling the product itself. And that's important because a lot of people don't market their product or advertise the product, they just put it out there. And then they don't have an active sales team that really pushes the product so that it actually gets off someone's balance sheet. Balance sheet's an important thing, especially with 4,500 ETFs out there now. Another point or pain point on the capital markets person is, especially with the conversion of mutual fund investors and mutual fund companies going to ETFs, is education. Education on how you execute a product or execute an order. So you may have a great market maker out there and they're making a two-sided market for you and they're on all the lit exchanges and dark pools, but because there's so many ETFs out there, because there's so many products out there, that they don't keep multiple level depths of large liquidity out there, because otherwise it's just a lot of risk. So a lot of products need to be executed through what we do is like an RFQ platform, or go through some firm that will reach out to the real liquidity providers, one of which is sitting here, GTS and Array, but also hitting all the big market makers that will do a size order. I mean, the risk is a lot of people put out like a market order thinking that it's very liquid, and the problem is that that's not the right way to execute an ETF order. So you don't have the deep bench of a newly issued ETF in a newly issued ETF like you would in one of the earlier ETFs like a EEM or EFA, because there's so many people that trade those products. So the newer products out there, you have issues with depth of liquidity, and you also have issues with selling the seed. So those two are important. The more ETFs that come out, those are going to be a real issue.
Yeah, so it's interesting, right? Because the part of the solution then is raising that barrier to entry for an ETF issuer, right? That they have to have the right product, they have to have the right amount of seed capital. They have to be associated with the sales desk, right? So that bar to entry now is getting higher and higher for a new ETF issuer. Yet we're still getting record launches, right? So that's not really slowing anything down. So, start again with Kristen and just have a conversation amongst the three of you about what are the solutions, as we see sort of cracks in the wall with the capacity. I think, Nick, you wrote a piece recently saying that, hey, the banks are starting to look at it. Are we going to get the big banks to come in and be lead market makers and perform more AP functions? Are there other, independent firms who are going to come in? Are your firms going to, or firms like yours, going to expand, right? Put money at it, right? Hire more traders, create bigger desks, right?
All of the above.
Where are we at that? Where are we with all that? Yeah.
We're doing all of it, and I think a lot of firms are. So we are seeing at least one major bank step back into the market making role. We're expanding our business, we're building it out, and we intend to grow significantly, in the coming years in that capacity. Again, just sort of servicing the expectation that, look, it's a very mature industry, but it's growing still at a very healthy pace. The share class approval could add some fuel to that as well. And so, the solution, right, is I don't want people listening or hearing this to think, oh my gosh, the market's broken. It's not. It's working. Everything is good. Like, everything is fine. But we're busy, everyone's busy. We're fielding a lot of requests, and it's coming in, and we are built to say yes. We're built to try to find a reason to work with you and to partner with you. But you gotta really, really fall back on the word partner. You're launching a product in the secondary market. You are no longer in the mutual fund SMA kind of environment. Now you're putting your stuff on the exchanges, which is basically the shopping center for ETFs. And we are the practitioners in that shopping center. And we are saying, look, I will commit to making sure there's inventory on the shelves for your product in the store that you choose, whether it's NASDAQ or ARCA or SIBO, whatever it is. We are going to do everything we can to make sure that as your wholesalers and your people go out and try to get interest in your product, so they buy it, so you have more assets because you get paid fees on assets. We want them to have a good experience getting into your product and hopefully never getting out of it. But if they need to, that they have a good two-way experience. Okay. It costs money, for GTS and for Murray and for others to provide those services. And so as this business continues to expand and more participants are coming, look, in the old days, there was a benefit to being a market maker. There were larger premiums and discounts in the market. There was lots of demand. You didn't really think the partnership part of it wasn't as important because we were living in a world where we could make a lot of money trading these ETFs and capture spread and provide liquidity, and everyone was happy and everyone was winning. But most of the ETFs don't trade. 99% of the volume and assets in ETFs are in like the top 1,000 names. So that leaves like 3,800 names that collectively make up 2% of the volume and 2% or 1.5% or the volume in the assets. Meaning that's a lot of work for firms like GTS, Murray, and our peers to do to keep them going so that they have a chance to work their way into the top 1,000 list or to become a going concern with lots of assets and lots of volume. The partnership, what I would suggest to anyone thinking of getting into the market or anyone who's in the market and frustrated, think about the way you partner with different people to make your business successful. So in the traditional sense, you work with research providers and you would get analyst reports or you get access to the analysts and you would pay for that. You would pay for that in some way. Corporate access, banking deals, like those are all partnerships that asset managers have. Right. And they pay for those partnerships. They in some way, shape, or form. It's important to think of your market makers as partners in your success. And you should be wondering why they want to do it. And if you can't come up with a reason, then you might want to rethink it, because it's really important to understand the effort that gets put in and how we keep our lights on. We don't keep our lights on with products that trade 1,000 shares a week, right? We don't. That actually costs us money. So but we want to be there. We want to support, what I can say though, the good news is this. I'm making it sound terrible. The good news is this: Dave and I, and Nick and others over the last 5 to 10 years, even longer, have just become much better at explaining all this to participants as they come in. All of our peers do the same thing. It's actually normal for firms to come to market, establish relationships with their market makers and their APs, understand how they make money and how the asset manager makes money and how they can all work together. That's the good news. So I guess it would be like a just quick warning flag. If you're coming into the market and you're not thinking like that, you probably should go back to the drawing board and start thinking like that. But most participants coming to the market already have that mindset. How can we work with you? Because we want you to put your best foot forward with our product on exchange. Is that fair?
Yeah, absolutely. And Dave, from your perspective, it's a little different, right? Because your capacity issue is going to be capital.
That's true.
And how much is your firm going to continue to support the ETF business in size? And when do we need to find, if I'm going to start a new business, is it worthwhile for me to start that business as a lead market maker? Are the economics and incentives enough for me to say, hey, yeah, I want to get into this business? This is going to be, because it's a low margin business. So from what I can see.
Lead market maker is a loss leading business. No one makes money being a lead market maker. Where you are able to recoup the fees that you put out there for capital and other costs that you spend on that is when you're able to capture a significant amount of liquidity on the tape from the trades that you're LMM in, or from the securities that you're LMM in, and then also from any sort of rebalances and customs or heartbeat transactions you might run on the back end of that. The important thing, and I think Chris really nailed it on the head, was that it really is a lot about education and understanding the marketplace. Because while capital might be an issue, if you have a strong partnership with your lead market maker, with your AP, with the rest of the ecosystem, then that doesn't really become an issue, because we will make the capacity to support you, right? There is no capacity limit when there is a good partnership there, when you are servicing and being and understand where you fit within the ecosystem. And so to that end, education is very important, right? There needs to be an understanding of what are the asks and expectations, how do they come to market, where do they find their assets coming in, what is the timeline for assets, especially if you're asking a broker to take on seed from your app, how long are they going to be sitting with this capital sitting on their books? So it really becomes about not so much the capacity issue, but where do you come in to this ecosystem? Are you able to act as a good partner there? Because then the capacity will be there.
And let's shift focus a little bit, right? So we're pretty much discussing current ETFs, liquid markets. We're seeing a move towards alternatives, private markets, digital assets, things that are maybe a little harder to source liquidity. So Nick, maybe you can start with you, as from your perch, when you need to source liquidity, for these less liquid type of products that are now going to be put into ETFs. How do you see that working?
Well, the ETF is a great wrapper for almost every asset class. Really, the one thing about this ecosystem is that there's a lot of smart people involved, and if you need help, they can help you. But as it expands, they're looking for different asset classes to go in there. So places like private markets seems like a great idea to give that accessibility to all the investors out there. But problem is that it's private markets. There's no real understanding of where things are worth. Even the investors in these markets beforehand don't get an update on a daily basis to like their relative value or their NAV. So if you're making a market in these products, you may have some firms saying, well, this is what it's worth, and And what, don't expect the trade redeems to go outside of a couple of basis points or something to that effect. And that's all fine and dandy in the beginning. But once there's some kind of disruption in the marketplace, say, recently there was just, I think, a few different private assets that went from being marked close to 100% to zero. And so if you're a market maker and you have like some of these ETFs on your book, and then all of a sudden like 5% of the ETF just went from being marked at 100% to zero, well, you're going to start making a wider market, right? I mean, I'm not going to be 2 basis points wide anymore because I'm not going to hold on to an inventory. And so these things, and then all of a sudden, let's say you have a big sell-off in the tech industry, or something else happens, or there's a war, none of these assets update on a daily basis, maybe quarterly, some of them. So I'm pretty much not a huge fan of the private assets group, but I do think a lot of other alternatives and a lot of the asset classes are good for ETFs, but what you really need is to understand how things are marked and priced on a daily basis. And for me, some things don't necessarily belong in an ETF.
Yeah, Nick, one of the things that the three of us, panelists think alike. It doesn't matter what you want to put into a wrapper, really. You can try to put anything in it, but what matters is our capacity to understand how we would value it. You have to think of us as we're taking the other side of it. We're basically committing to saying, I'm willing to do the work to think of some fair estimate of what I think this underlying asset is worth, whether it's liquid or not, especially if it's illiquid. If it's liquid, it's real easy. If it's illiquid, it's harder for us to do the math. Now, but we'll do it. There's going to be a point where we're going to be like, look, I think this is worth $50. Like I'm willing to pay 50 for this underlying asset in the form, if it's in an ETF, and I'm willing to sell it at 60. That's my range. I don't know if I can get any tighter than that because there's not enough information out there and there's no liquidity and things like that. Think of that's the way we think about everything in an ETF. Then you can get a little more complicated with it. You can say, well, what about ETFs that have all these different types of products in it? They've got equities, they've got options, they've got futures, they've got treasuries, and they've got, swap exposure. They put everything, they throw everything in there. Okay. On the surface, the first time we see it, we're like, oh gosh, it's not impossible. It's just a lot of work. Then we have to go into each different compartment of the ETF, figure out if it's liquid, figure out if we have confidence in the pricing of that. Do we have a high degree of confidence? Can we make it tight? Do we have a high degree of, where we would buy and sell? And then we sort of add all that up, we sum it up and say, this is what we expect the spread of your ETF to look like if you were to bring it to market with the stuff you're putting in it. And here's why. We provide that service. I know that, Dave and I and Nick has probably done it in the past, when he was on the market making side, where they'll come and they'll vet it with us and we'll tell them, like, you've got 3 things in here that are incredibly difficult to price or source. And so for that reason, your ETF is probably going to be 20 basis points wide. If those things weren't in there, we probably could be 5 or 6 basis points wide in your ETF. We are not telling managers what to put in or what to put out. We're just providing feedback and saying, if you want us to make a market in this on the exchange, these are the things that we're considering. So again, we're not trying to talk people out of coming up with more creative products and putting different exciting new things in an ETF, but you should be thinking about, if the ETF didn't exist, what does it cost investors to get into this asset or get out of this asset? Because that's what we're thinking about. Because ultimately, you're just passing that obligation on to us. Like we become the source of pricing for what would otherwise they'd be shopping for in other venues, but they just want it in an ETF wrapper. So you're just putting Dave and I in a position to be the marketplace for the underlying asset.
And it makes it more difficult the more asset classes, like you said, that you have within that wrapper. Your spreads are going to be wider, your liquidity is going to be worse, right? That's not to discourage it, because there are some good products out there that are multi-asset class. When we talk about the private markets in particular, where you're looking at is where are you going to find the liquidity for those assets on the back end, even if you're restricted within that wrapper for only holding a small percentage. There is a cap on the amount of liquid assets that the ETF wrappers can hold. And what we found, we have an offering called ClearList at GTS where we do private markets, but there needs to be a setup where you have a market maker, someone who's going to be on the back end in order to provide liquidity on both sides of that. And that becomes more and more of a struggle. And then how are they pricing on the back end? All of that needs to be transparent and laid out to the market so the market makers that are out there can efficiently price the product and provide liquidity and have confidence in the levels that they're providing. Because if that's not all laid out there and that's not clearly put out there, you're not going to have the liquidity and your spreads are going to be very wide.
So if I was to put an umbrella over this conversation, it would be labeled risk management, right? So that's basically what you're doing when you're talking to your clients and you're looking at new products. You're looking at the risk and you're trying to manage that risk both for your own firm and also for your partners, right? And you're explaining what those risks are. What we're seeing in that space, again, on a very general basis, and we talk about solutions here in the growing industry, what role does technology play and new technologies coming out that are helping you? And you can't have a panel discussion in any industry right now without saying AI. But in more general terms, is there more technology coming out that's going to help you in this risk management function as you're looking and trying to source liquidity and look at new products?
Well, I can answer that a little bit. I know that AI certainly helps a lot in the programming area of the business. I know some programmers, people I've dealt with, market making and APs and whatnot, and they're trying to. There's new products coming down the line every day, and then you got to price them. You got to put in risk allowances. You got to make sure that things are correct. The options are priced correctly. That takes time. You can't just like it used to be a quick spreadsheet on a few stocks maybe, but nowadays these things are a lot more complicated. So AI helps a lot in programming. Certainly can help reduce the time for setup and stuff of that nature. I know that a lot of programmers love it. Obviously, it's not perfect, but it helps. They say it cuts down programming time in half or even more.
Right, and that's another capital deployment for a firm, right? Putting capital into building out those technologies, right? So are you seeing that happen? It's been happening throughout our entire careers. The change in the technology and the trading desks. Has that evolution? Are you seeing more and more changes now? Chris or Dave, however you want to.
A little bit. I mean, look, the equity market structure, the listed markets, there's always a speed and an evolution of the technology, but it's not as fast and furious as it had been. I think obviously with Bitcoin and other digital assets, in ETF wrappers, that's a whole new technology set and a whole new, processing set that we're seeing evolve and be more efficient and safer and protections are in place. I think you mentioned AI. I mean, AI and things like that are certainly helpful for firms like ours to sort of model things out, to help think about things differently. That's the good news. But it's kind of like a fantasy land in a sense, because at the end of the day, we're still, this is the dirty back end of ETFs and creating and redeeming and everything. We still settle our trades, with the DTC and NSCC, and we still deal with agent banks, and we still deal with, fund administrators. And there's so many different participants in the ecosystem to make it all work. You're talking about market makers and capital markets today, but you've got the custodial banks and the fund administrators and the auditors and all these things. And there's so many, there's not thousands of them, but there's a dozen or so different players that are involved in this, and they all have a different operational structure. And a lot of that operational structure is way behind on technology. It's dark ages. I don't think AI is helping. So Dave and I and Nick might be able to come up with a really cool pricing solution for an ETF, but it might be all for naught because we still have to go through this archaic settlement process in the end where it's just not as clean as you'd like it to be. So So I guess there's the answer is yes, AI is super helpful, but only to a certain extent. You know, that at the end of the day, our DTC and Fed Ops and PNS teams are still dealing with emails and chasing fails and cash deliveries before the wires cut off and things like that. It's a lot of work behind the scenes, and I don't think AI is helping that at all right now. You know, I don't think there's any solution there. It's still there's still a lot of manual um, processing that happens on the back end, and that slows things down quite a bit. But it's okay. But it's okay. It's perfectly fine. Like we're good. Everyone's, you know, I'd say we have the best job because we don't have to deal with it so much, but we have to hear it a lot from our back office. But you know, market participants, buyers and sellers should never be concerned about that because we've been doing this now for 30 plus years and everything's fine. You know, assets continue to grow, products continue to come to market, but just know that, you know, I wish there was a magic button to make everything settle. Now with tokenization and things like that that are on a lot of people's minds, you know, the thought of instant settlement and, you know, 24/7 and all these things like that, you know, that we should all be thinking about that. There's a real likelihood that in our lifetime we might see that. And that could eliminate a lot of the things I just talked about, you know, settlement and back office and all of that, those pain points if things were tokenized and settlement process changes and things become faster and more efficient in that regard. But I don't think we're there yet. I think we're still talking about it. And I think everyone agrees it's probably coming. We just don't know how and when. And but yeah, you know, I mean, I'm logging into as many of those webinars as I can as well.
Yeah. So that's a good segue into the ETF multi-share class, right? Because that's going to change things a little bit. There's hold up now because of what's happening at custodial banks and the deeper plumbing and operational process of that. So Dave, why don't I just jump with you? Have you been working on that, looking at those solutions for those funds to be coming out, and what's your view on it?
I think most of our concern on that side is really having a good partnership and being able to support the additional capacity coming in. We're not as concerned like where Chris might be from the AP side, the mechanics that are involved there. I think the real struggles that are going to be associated with the share class is operationally based and for the APs, because you have this mutual fund structure which has a very different creation redemption mechanism that's been in place versus the ETF creation redemption mechanism. And now you're having DTC start a new project. And while I love the folks over there, it's like AT&T from the 1970s. They are a monopoly and they don't move particularly fast. So it remains to be seen how, and I know there's multiple working groups and they have dates of where they're going to be able to support this. But right now, the initial bit is going to be very highly manual. And that, from our perspective, creates concerns for our IPs in order to be able for them to support that. And I think Chris can speak probably more to that because you've probably done a lot more work on your side, because the operational stress will be on you.
Yeah, I mean, it's definitely, we don't have the answer. To today's point, we don't really know what the solutions are going to be. And then to complicate things further, you've got several large custodial banks that are involved in all of this, and they each have different processes behind the scenes. And so we have precedent, right? Vanguard had the share class for quite some time on their own, and there's a process behind that that most of us are very familiar with. But you know, we're going to see how Dimensional comes to market and how that plays out. We're going to see how the first few iterations of it go and see where the pain points are. I mean, it's kind of, I hate to say we're a lot in a wait and see mode right now to see what's going to be needed and how those things are going to happen. But we're really waiting on the fund admins and the custodians to sort of come back to us and say, all right, this is what we're thinking. I expect that we're going to figure it out pretty quickly. And, you know, I think if they were to show up tomorrow, then tomorrow we start doing it and we figure out the pain points and we solve for it. And if we have to hire another person and you know, the demand supports that, then we would just do that. We'd say, okay, your job is to focus on mutual fund share class ETF, great redeem, and because of how manual it might be. Hoping it's not, but we'll see. We don't have all the.
Yeah, and we're hearing so many different things, right? Which is hard. Can't believe can't talk for SEC or SEC processes, right? But investment management side of the SEC sort of approve these, but trading and markets at the SEC are a little bit more reluctant. And it sounds like it's going to be a case by case approval. I think to your point, Chris, that's about who are your partners, who's ready, who's not ready, who's going to come out, so that first to market, the ones who come out to market, doesn't feel like it's going to be a rush of all these new issuances at once. It seems to be going to be a measured approach, making sure that the back end works for that particular fund. Am I describing what you're hearing and seeing as well?
Pretty much, yeah. Mm-hmm. Yeah, I mean, I wish I had more answers for you, Rich, but it's,
No, that's the process, right? None of us have the answers. We're just trying to keep an eye on what's coming at us, right? And that's when we talk about capacity issues. And yeah, like we said earlier, the industry is cranking. So everything works. And Chris, you're very good. Like, don't worry. Everything, there's nothing coming at us in the immediate future.
Yeah, but this conversation is giving me some anxiety. So just.
Yeah, we don't want that, right? And again, comfort from the amount of issuances, amount of AUM coming into the marketplace, it's sufficient. The ETF market always has been efficient. It's been one of its hallmarks, right? That's not being threatened.
No, but it's important to note. Again, I think everything's working. Like if you were measuring the health meter of the ETF ecosystem engine, it's super healthy. Like it's pinned on perfect. And the guys in the control room are just looking back and like, okay, the market makers are doing great, the banks are doing great, custodians, everyone's happy, right? But again, we talk about capital and balance sheet and things like that. Next week is expiration. We have potentially the largest, quarterly expiration ever coming up next week. So there's a ton of demand on balance sheet at these times of stress. Add mutual fund share class into that. A lot of those are index, they could be index based and they could be trying to rebalance at the same time. Will the street collectively, the banks and the broker dealers and the market makers, be able to handle the demand? Yes. Will the cost of doing that business stay the same? Probably not. The more demand and with limited, again, I say limited capital, and there's a ton of capital out there, but at next week, the spike of capital demand is going to be astronomical. So the cost of that capital, you should expect it to go up. If you're a big, giant asset manager and you're asking a participant that you work with to tie up of their own capital, $1 billion or $5 billion or some ridiculously large number like that, they want to say yes, but they have to prioritize. If they got 15 people asking for large allocations of capital, they're going to have to figure out which one is best for the company, which one is best for the bank, which one is best for the dealer, and they're going to have to sort of rank it in a sense. You can't say yes to everyone. So understand that as the industry continues to grow and more participants come into the market, there's more demand and more asks for firms like ours. And we have to think about who our best clients are and who our best partners are, where the best deployment of capital is. We can't commit capital to make, overnight funding when we could be committing the same capital to make overnight funding plus 5%. We have a fiduciary obligation to the company to invest our capital wisely and use it, for our clients in the best capacity. So if we've got 5 people asking you, we can only say yes to one, we're probably going to be working with the best partner of our firm. So the ecosystem right now, perfectly healthy. I think everyone's getting what they need, but I think people should probably be expecting that as more and more people come into the ETF market, more and more people start asking for different services and capital, balance sheet usage and things like that. The cost of those trades and the cost of those commitments could be going up in the future. I think it already has. actually, to be honest with you.
Right. And that's an issue we went into from the beginning of the ETF space, right? We're top heavy. A handful of firms operate the majority of assets, majority of funds, and anybody under that has got a hard time finding space. And I guess it will come to, a head next week as firms are looking for that capital commitment. So as much as everything is fine as is, and we're cranking, how do we get to the next level of growth? Right? Because I think that's where we're talking about capacity issues, the capacity to be able to grow. The smaller players fighting for air, right? So then we get fewer players, or again, all the banks or other firms going to come into this space and service it from a capital markets perspective, right? We've had banks come in, on the fund admin side and the service side on fund admin, they've come in as issuers. So they're finding ways to make money in this industry that's just exploding. But at one point, do they say, hey, if we really want to grow this space, this is where we need to deploy our capital, and they start coming in on this end of the business. And are you seeing that? Is that a reality of people? Are there enough economics for them to do that?
I think they're figuring it out. I do. And there's other things that we do on the back end. We have conversations regularly with the NSCC folks, and the chart, like as a clearing member, it costs money to clear all the trades that the firm is executing and clearing for clients and for their own book. And the banks have the same issue. So, there's charges, there's VAR charges and gap charges and all of these things. And we don't always agree with the charges. They are what they are, so that's a conversation that no one listening to this is ever going to be a part of, probably. But you should know that in the back, we're looking for ways to maximize our capacity. And I speak for us, and I think every bank is probably saying the same thing. They're looking for ways to maximize how much they can do for the demand that's out there, and do it more efficiently, and be reasonable about it. So, I think that's, the good news is that we're servicing the market. We've nothing's broken and everything's fine, but we're always thinking about capacity, and we never want to put ourselves in, as an industry, in a position where capacity becomes a real problem. But we talk about it a lot because we want people to understand that they shouldn't take for granted what the exchanges provide, what the custodians provide, what the market makers and APs provide. You cannot take it for granted. It's just not I'm going to launch a product and raise $1 billion and make my 50 bips management fee and live happily forever. Like, no, there's a lot of other firms that are involved in your success, and you really need to take that heart and appreciate it and understand it, and make sure that all of the different components of your success that are outside of your control are healthy too. Because if one of them starts to break, the whole thing comes to unravel. So you just want to take a step back, figure out what makes your product work, what makes your success story work, and make sure that all of the people involved in that, all the firms involved in that, are healthy and spinning on all wheels. Right? Dave, would you agree?
Yeah, I mean, we do need to make sure that all parts are there and ready to go, because the one thing that we don't want is anything not to hit smoothly and for everyone involved, right? So it's key to make sure that we have everything lined and measured to make sure that it all hits the market effectively.
And Nick, from your perspective, right, sort of have a broader view of the space, where are you seeing advancements? Or where do you want to see the advancements that will help the industry get to a next level of growth?
Well, I think one topic that I think we've kind of danced around and need to talk about is, especially for those new entrants, partnering the right way. One thing that we could do, or at least discuss, is possibly paying for lead market makers or liquidity providers, because in the beginning, they're really, if you're a new issuer, you're trying to get someone to give you a good market, but you're not really adding value to that lead market maker. And so, they're wondering like, how are we going to partner? And I think like for those, just like they do in Europe, they actually pay for market making. And in a way that we do pay for market making in other ways here, it's kind of building this holistic relationship, which is very important. But basically, it's like you're kind of building a relationship with them. They'll make a market in your product, but then you give them some business, say in the rebalancing or the portfolio management of your funds, which is very important to do. But especially if you're a newer fund and you don't really have too much assets under management to rebalance, I think an area that we should look into is possibly having like a tiered system or some to that effect where you can have a more straightforward relationship with liquidity providers and other people in the industry.
Yeah, and that conversation has been around for a lot of years, right? So back when I worked at an exchange, we had talked about that, right? And the SEC said, hey, I can't align an issuer with a market maker. It just doesn't fit within the sort of rules of exchanges where issuers and market makers have relationships. That begs insider trading on corporate issues. So yeah, the exchanges have incentive programs. So like, is there an adjustment there that can be made?
They're always making adjustments. They're constantly adjusting it, listening to the market participants, taking feedback, talking to the issuers, trying to figure out ways to keep us happy.
To that extent, I mean, they are coming out with some new programs. Both the NASDAQ and CBOE are coming out with new programs. NYSE already has a program with market maker incentives from their DMM, which is a floor offering. CBOE is coming out with something similar, and there's also new bucket systems with incentives for different market caps and different asset classes, so that the incentives program that's out there will be tiered based upon what type of asset class you have. So you're not going to have the same requirements for an LMM that's doing something with CLOs and munis in it as you are going to have just a straight domestic equity product, which is of added value. And then there's also bucketing for like notional size as well, because as the assets of an ETF grow, the secondary volume comes significantly higher, and therefore you're able to have tighter spreads because you're not just relying on a single lead market maker in order to provide liquidity there. So these are all great incentives, and they always keep on tweaking these things. And to that end, the potential new offerings from CBOE and the current one from the DMM on the floor do have a little bit of an incentive for the lead market maker in that case. Not quite getting around 5250, but still some progress being made there.
Yeah, and what's amazing about that is the exchanges have really tight margins on that business, on the ETF business as well. ETF listing fees are a fraction of what a corporate listing is. Transaction fees are down to fractional pennies. So they're hard pressed to find the capital to incentivize you properly, right? So ideally, it would come from an AUM of an issuer, because that's where all of your work is flowing, right? The work as an exchange, the work as a ETF provider, operations provider, and your work on the market making trading side all ends up in the AUM of the issuer. And how to get that back down to the operational level under current regulatory statutes is a little challenging, but I think that's what people are trying to get to. And so we're kind of at the end of our time here. So I just want to thank you, Nick and Chris and Dave, for your time and expertise in this panel. It was wonderful. I'm sure we could go for another hour if we wanted to, but we'll let everybody get back to their day-to-day work. And again, we thank you for your participation. I hope everybody that's listening, thank you for participating here and listening. And I hope everybody enjoys a great day and a great holiday season. So thank you.
Same to you all.
Cheers.
Thank you very much.
Thanks, gentlemen. Bye.